Hi, I'm Brent Farley. I'm the managing member of Farley Law, and today I want to talk a little bit about what the presidential election means for banking for the next year. Uh, Honestly, I want to start a little bit before that as well. So let's talk about how some Supreme Court changes this year and the election are really going to change banking for 2025 and probably beyond. So to kick things off, early this year, the Supreme Court with Loper versus Bright undid the Chevron deference doctrine that courts have applied to agency rulings for over 40 years. So what Chevron deference meant was that if an administrative agency of the government, so the Office of Comptroller of Currency, FDIC, Federal Reserve, or other agencies like the FTC that might also impact banking, if they made a decision regarding what a rule ought to be or what the result of an enforcement action might be, then a federal court would only review that action on an abuse of discretion basis. And that means that the court would only overturn or walk back that decision if the court decided that the agency abused its very broad discretion in how it adopted a rule or how it applied a rule or how it enforced a judgment. And so what that meant is that agencies had a really broad range of authority in the way they interpreted their rulemaking ability from Congress, the way they adopted rules, the way they applied the rules, and also the way they enforced the rules. And so when the courts walk back Chevron deference, what that means is that if a bank or a private party disagrees with a federal agency, it should be a lot easier to go ahead and challenge that agency's interpretation of a rule or application of a rule with respect to that person. And so, for example, if you were to go to agency rules regarding capital, or if you were to go to agency rules regarding fair lending, a lot of the rules that are based on the agency's discretion may be subject to more review by the courts. In a lot of cases, will be subject to more review by the courts. And particularly with respect to new rules that have come out, I think it'll be much easier to challenge new rules that have come out where an agency has taken a very broad opinion as to their ability to make rulemakings. I think we're seeing the effects of this already. I think we saw with the CFPB rules on 1071 and 1033 regarding small business reporting and open banking. We saw early and quick challenges to those rules, and those challenges will be based on the new standard of review. I think that's a precursor of things to come. I think if you take a further look into case activity that's followed Loper versus Bright, you'll see a lot of challenges to long-standing agency interpretations that industries have found to be painful, and that'll be across banking and just about any other industry that I can think of that is regulated. All right, so following on the heels of Loper versus Bright, had a very contentious presidential campaign season. We had President Trump come back for a second term, which is very unusual in the history of presidential politics. What that does for us, I think, is offer some unique insight into how President Trump might view policy direction, rulemaking, agency policy, and priorities for agencies in the coming months. So I think we can take a look back at what we saw during the first presidential term, and I think we'll see some similar themes and methods and preferences and priorities in the current term. To be a little more concrete, I think, well, go ahead and start with agency administration. The OCC and FDIC leadership are appointed by the president, and so we will probably see some shifting in leadership at the FDIC. We'll probably see a change in leadership at the Office of the Comptroller of Currency. That also goes for the Consumer Financial Protection Bureau. We'll probably also see leadership at that agency change as well. So when you change the agency head, what we see happen is that attitudes towards the way regulations are enforced or the way applications are processed change. Priorities shift. They might look at certain aspects of an application or a rule or regulation differently than the former administration did. And so effectively what we see is a shift in priority and process and the ease in which some things may be done. I think with this term, I think a lot of things will be quite a lot easier than what they have been in this current presidential term. Other things we might see rules being walked back. So this year we saw 1071 on small business reporting and 1033 on open banking challenged by the industry. I think one of the things that will happen is a new director for the CFPB will come in, and that director may have a different opinion on the direction that those rules may need to take. So you may see them walk back. Those cases could potentially be cut short if the CFPB decides that those rules need to be withdrawn. We could see new rules delayed. Another thing that may come up depending on the election for the House of Representatives that hasn't quite finished up yet is that the Congressional Review Act permits a majority of Congress to overturn a proposed rule by a federal agency. And so we could potentially see Congress take a look at some of the rules that are coming through the pipes and say, we don't agree with this rule, or we don't agree with that rule. And you could see some of those rules go away before they're finalized. Prior to the election, we had planned on this month talking a little bit about mergers and acquisitions. And in light of the election, I just wanted to take a few minutes and comment on, how might a presidential election change the way that mergers and acquisitions are processed for banks in the United States. And so for banking, unlike a lot of industries, if you want to merge two banks together, there's a regulatory process that has to be followed. There's an application for the merger, and it has to be approved. And depending on the type of institution that's acquiring, that might be by the Office of the Comptroller of the Currency. It might be by the FDIC. And the Federal Reserve may also have an opportunity to weigh in depending on the size of the merger and on whether or not the Federal Reserve has oversight over that particular bank. And so one of the things that we see happens in the dynamics of a merger is that the two parties will collaborate and work on a merger and its terms and conditions. And then they'll have to push the merger to the regulators to decide whether or not the merger can actually go forward. And so if you can think about on the capital raising side and on the selling side and the buying side, what the delay of an application might mean to your deal, because an application might take several months, maybe 9 months, maybe even longer to approve, that can really have a strong impact on on the deal terms, on whether or not the deal closes, on whether or not anybody wants to enter into negotiations for a merger acquisition. The context of the merger application matters too. All right, so in an application, federal agencies will consider the proposed management for the institution. They'll consider the capital adequacy for the institution, the ability of the new institution to comply with anti-money laundering regulations, other compliance issues, Community Reinvestment Act considerations. And so if you think about the different aspects that an agency reviews in a merger application process, then you think about the policy priorities that might be pushed by one administration or another, you might start to see how one administration can drive or stall or accelerate mergers and acquisitions activity in the economy. So currently, what I think will happen is I think we'll see a preference for a faster review period, a process that's a little more friendly towards business in general and towards merger and acquisition, probably with some caveats. And I also think that we'll see a little bit more friendliness towards non-bank acquisition of banks. So if we have a fintech that's looking at acquiring a bank, you might see more activity in that direction. And for that matter, we might see a broader acceptance of cryptocurrency activity, cryptocurrency players in looking at bank charters or bank access, maybe not full charter, but having greater access and mobility within the banking industry. And so thinking about the presidential election, the effect of Loper versus Bright, I think the overall business climate for banks will be quite a lot easier than what has been over the past several years. See a lot less aggression from federal agencies toward banks, towards consumer lending, consumer products. And we may see some de-emphasis on themes like fair lending, and diversity, equity, inclusion, and also environmental, social governance. Now, for our last little topic before we sign off, I just wanted to walk through a little historical perspective on how changes in the president can really affect industry. So when Biden came into office, and if you were watching the news, showed him sitting at his desk with a stack of executive orders sitting on his desk. And one of the first things he did in office is he started signing executive orders. Those orders had a pretty broad scope, so we won't talk about them all, but some of them had to do with environmental and social governance and reporting. And so at the time, one of the things that was happening is that Congress was locked up and had not been making a lot of policy decisions in general that it might otherwise do because of general disagreement, the split in Congress. And so one of the things we saw happen was that the president, through executive orders and through directions to federal agencies, started to create reporting requirements for environmental, social governance issues for securities. So if you were issuing stock, or you want to issue a bond, or you had some other proceeding before the SEC, you started to see ESG reporting requirements piled on top of the other things that you might otherwise have to do. At the same time, other things we saw federal banking agencies start to impose guidance and requirements for banks to assess how climate change was going to affect their portfolio, how other similar issues had bearing in their loan portfolios. So what that does is now investors have something new to look at when they're evaluating a bond or when they're evaluating a security, and it affected the way capital was raised for oil-based industries. And it affected the way capital was raised for high carbon use industries. And we saw some real difficulties arise for banks who fund those sorts of industries, for governments who had friendly policies to those sorts of industries. And so if you can think, if President Trump steps into office, what were some of the first things that he might do is maybe unwind some of those types of policies and maybe reverse them. And it may take cue from the current administration, and maybe try to use agencies to push his own agenda. So we're thinking about what is banking going to look like in the next 12 to 24 months. It's going to change. Attitudes are going to change. Policy direction is going to change. And hopefully it should become a little bit more friendly towards the way things are working for banks in the U.S. Thanks for watching. I'll talk to you next time.